Welcome to September's Wrap the Month, where we show you in 11 charts how the markets performed. Hint, September, worst month we've had, year to date 2023. Let's go. All right, so as I mentioned in the opening, the month of September was not kind to really anything. S&P 500 was down 4.73%. The NASDAQ composite was off 5.83. Small cap stocks were off 6%, and the Vanguard total bond market was off 2.49%. So, tough month, interesting month. So far, month of October is turning out to be much better. So hopefully that can continue as of the recording here. But that's where we are for the month for the indices there. Let's kind of jump into each of our holdings. S&P 500, SPY, was down 4.73%. Equal weight, which is a common theme we talk about every week, the S&P 500 equal weight is the equal weighting of all 500 stocks where we have the cap weight. And again, cap weight is outperformed, not by much, but still outperforming 4.73 down versus the equal weight, which was down 5%. Vanguard dividend appreciation was off 4.24%. Small caps off 6.01%. International stock from Vanguard down 3.4. International small caps from Schwab down 5.22. Vanguard short-term bond off 0.5%. Essentially, total bond market from Vanguard down 2.49, and the Vanguard total international bond down 1.75%. Let's jump into how the markets performed over the past 12 months. S&P 500 up 10.33%. NASDAQ 11.87%. There was a much bigger discrepancy, but as you can see that it's starting to pull back a little bit. Schwab small caps 0.23%. Vanguard total bond market down 3.49%. S&P 500 up 10.33% cap weight. SPY. RSP, which is our Invesco S&P 500 equal weight, only up 2.93%. Again, a huge discrepancy. Such a small percentage of the holdings in the cap weight are driving the market, and the market breadth is not there, which we will see in the next charts that we get into. Vanguard dividend appreciation past 12 months, 7.75%. Schwab small caps past 12 months, 0.23%. Vanguard International past 12 months, 8.62. International small cap, 4.92. Short-term bonds over the past 12 months, we're still seeing a positive there, up almost 1%. But the total bond market, the longer intermediate play, down 3.49. International bonds down 0.75%. Year to date, S&P 500 is up 13%. NASDAQ is up 26%. You see that discrepancy there. The NASDAQ is really flying. Small caps really have not performed, which also leads into the RSP cap weight. So that's only up 3.31% year to date, and the bond market's off almost 1%. SPY up 13% versus 1.69% on the equal weight. This month, year to date, we're seeing a little bit of a better showing by RSP. Equal weight is outperforming cap weight, but you can see that's a huge problem for this year, which I will be addressing and looking into for the start of next season to kind of see what I think. Vanguard dividend appreciation year to date 3.85. Schwab US small cap 3.31 year to date. Vanguard international stock 5.4. Schwab international up 2.98. Vanguard short term bonds 1.39%. Total bond from Vanguard off 0.9, and our international bond, which has held its own, is up 2.04%. Market breadth. S&P 500 is trading below its 50-day moving average, which is one of the bullish indicators that we were looking at. But we're trading below the 50-day. We got close to the 200-day, but bounced up. So we're still in a long-term positive trend based on technicals here, but we're kind of failing on the shorter-term trend, which is the 50-day. Relative strength is down. Relative strength from the past few months back to when the summer started was basically over 70%. Now we're down to 34%, which is a bearish indicator. Percentage of stocks above the 50-day moving average is only 15%. As you can see here, back in the summer, we were up at almost 85, 90%. Huge divergence there. The number of the S&P stocks above the 50-day moving average is 77. So 77 out of 500 represents 15%. That's what that chart shows you. It's the same data, just a different way to look at it. Percent above the 200-day moving average, we're down to 40%. Again, start of the summer, we were up well over 70. And that represents, you've guessed it, 40% of 500 is only 203. So again, S&P 500 showing signs of divergence from at least from the beginning of the summer. And you can see here from these numbers. Let's look at the NASDAQ. NASDAQ is kind of the same thing, not as bad as the S&P, but still getting down there. Again, we're trading well below the 50-day moving average, which represents a short-term bearish indicator, but we're trading above the 200-day, which represents a bullish indicator. Relative strength, not good. From where we were in the summer, we're down to 38%. Percentage of NASDAQ stocks above the 50-day moving average, we're down to 20.69% from well above 70% at the start of the summer. Percentage of NASDAQ stocks above the 200-day is only 27.77%, as you can see here. Let's get into, again, when we look at growth versus value, growth are companies that are typically technology companies. They don't issue dividends. They're reinvesting into their company to grow, hence the term growth. Then value are typically more of your blue chip kind of companies that have dividends that while they are still trying to grow, but they're not investing so much back in to grow, they're also giving back to the shareholders, and they're also deemed to be kind of cheaper in the marketplace at times. So that's growth versus value. They represent different trends in the marketplace. In this one, value outperformed growth, but they still did not have good months, where value is off 3.87%, growth was off 5.45%. So both of them were down for the month of September, which you could surmise based on the other charts that we were looking at. But value did, in fact, outperform growth. It's all about how you slice data, how you slice numbers. So, yeah, 1.68% value outperformed, but they were still down. Offense versus defense. Consumer discretionary versus consumer staples. Discretionary underperformed staples by a negative 0.81%, which you would think, in a really bad month, you would think that people would be and investors would be leaning more towards the safer areas, which would be staples. But again, they were still down. So you're looking at the discretionary was off 5.55, where staples were off 4.77%. That's how you have staples outperforming discretionary. One of my favorite charts to look at, the good old consumer sentiment. Consumer sentiment dropped from 71.6 to 63%. Now, one would think, based on everything that's going on, how in the world is it 63%? How is it 71%? How is it 88%? I don't disagree. Somewhere, somehow, 63% of the people that the Michigan Consumer Sentiment Index polled have a positive outlook. Yields, the yield curve is getting a little bit better. It's not as inverted, but we are still inverted, as you can see here. Once this, as we've spoken about before in the past months, once this green line breaks below zero, we have an inverted yield curve. What does that mean? Well, that means that shorter term rates, like the 2-year Treasury, are paying more than longer term rates. So as you can see here, the short term Treasury is yielding 5.09%, where the 10-year is yielding 4.71%. There's even a bigger discrepancy in the even shorter rates. We have a 3-month Treasury, which is yielding 5.61%, compared to the 10-year Treasury yielding 4.71%. Well, that's a wrap, no pun intended, on another Wrap the Month for the month of September. Hope you'd enjoyed it. See you next month.